sell side of finance are those firms that create and then promote the sale of stocks, bonds, foreign exchange, derivatives, and essentially any other financial instruments available in capital markets. Hence, when companies decide to have their initial public offering, issue bonds, or buy back their stock, they rely on sell-side institutions to do this. In turn, when asset-holding institutions or retail investors want to buy these instruments, they need to have a relationship with sell-side institutions to be able to buy them off them. Hence, a symbiotic relationship exists on Wall Street where the sell and buy side exist together in harmony and could not function without the other. The sell side is dominated by the banking sector, namely investment banks and commercial banks. Examples of investment banks are Goldman Sachs, JP Morgan, Barclays and MUFG, while examples of commercial banks would be Wells Fargo, US Bancorp and PNC. Collectively, these firms try to sell their products and services for the highest price possible in order to create revenue. Traditionally, the sell side has also provided insight and analysis on such financial assets in the form of institutional research. Against the backdrop of financial deregulation, the early 1980s to 2008 was an extremely profitable period for sell-side institutions, often being dubbed as Wall Street's golden era. The first signs that this period was ending appeared in 2007 when US real estate prices began to collapse, and it culminated in the financial panic witnessed in global markets during September and October 2008, which ushered in the most serious economic recession since the Great Depression of the 1930s. Since the onset of the global financial crisis, the trends seen on the sell side have been in stark contrast to those witnessed in the 25 years previously. The main driver of these changes has been the increased scope of regulation directed towards them following the passage of such acts as the Dodd-Frank and Consumer Protection Act, Basel III, MiFID II, Foreign Account Tax Compliance, and the Department of Labor Fiduciary Rule. While this increased regulation was designed to strengthen the overall financial system and protect the retail investor, Main Street's gain has been largely Wall Street's pain. This is because the cost of reshaping financial markets has been shouldered largely by the sell-side institutions. In turn, these costs have resulted in three main trends seen on the sell side since 2008. The first trend is the outsourcing of internal infrastructure. During Wall Street's golden era, most sell-side institutions believed that there was a competitive benefit to having internal infrastructure, like IT and proprietary applications, developed and maintained in-house. The high degree of customization and instantaneous support that offered by doing this was, at the time, seen as being crucial to the organization operating effectively. It was given little consideration to how many auxiliary members of staff it would be required to create, maintain, update, and support these internal systems, and the operational risk associated with important members of these teams were to leave the firm with critical pieces of knowledge. Due to the need to cut costs and redirect the savings towards the implication, monitoring, and compliance of the new regulation, off-the-shelf technology and applications are now being preferred. In the current environment, the sell side sees the managed services offered by third-party vendors as being less expensive solutions, and as such, the cost savings is worth the potential limitations faced with a one-size-fits-all solution. This is because not only is the implementation and development cheaper, but by being able to outsource the maintenance and future enhancements, there's further cost savings. Consequently, the total cost of ownership of these solutions is seen to provide the large cost savings these institutions require to function effectively while still being compliant with the new regulations. Related to this concept of reducing the total cost of ownership is the notion of vendor consolidation. Previously, most sell-side institutions chose to have multiple vendors, usually because they wanted the best in breed for each specific function, but also due to diversifying the risk of a vendor having technological or financial issues. Consequently, this led to each sell-side institution having many different systems, many different contracts, and high technology costs. Since 2008, the sell-side has changed this view and chosen to purchase more services from less vendors, as it puts them in a stronger position to negotiate a more cost-efficient overall contract, as they will develop a bigger relationship footprint with that vendor, and they hope to partner with them. This will, therefore, further reduce the total cost of ownership while reducing the complexity of contract and relationship management. Such arrangements also negate the need for sell-side institutions to pay for large teams to support their technology, while also outsourcing the risk of key members of the support team leaving the firm. Consequently, such managed services and vendor consolidation are fast becoming the norm on the sell side, even in organizations where this would have been unthinkable before 2008. The second trend we're seeing is in automation. Increasing regulatory pressures has also forced sell-side firms to invest in upgrading their reporting systems and improving operational risk measurement and management, while increased competition is the key driver for investments in enhancing trading platforms. Since 2008, sell-side firms have realized the importance of managing operational risks, leading them to invest in developing enterprise-level risk management systems for better risk assessment, management, and reporting. Unlike the pre-financial crisis world, data quality issues are now considered to be the major source of operational risk to sell-side institutions. This is because post-crisis, regulators brought into focus how inefficient their previous management of operational risk and human error had been. In turn, this has prompted firms to increase their spending on automation, especially in the areas of order execution, risk management, valuation, and reporting. By automating processes and functions, sell-side banks soon realized that they were gaining a competitive advantage as it has reduced errors and has allowed them to do more with less, both in terms of the number of people and the number of asset classes that they can cover. Trend 3 is juniorization. The final trend observed on the sell side is inextricably linked to the automation and managed services trends. Namely, a further way that the sell side can reduce costs and to remain profitable in the increased regulatory environment post-2008, juniorization simply means that the average age of an employee on the sell side is getting younger. However, this isn't because the organizations are increasing their total headcounts with younger employees. It is due to banks firing older, higher titled and more expensive employees and replacing them, where needed, with younger, cheaper workers. While most of the sell side has been actively reducing headcounts in general, even those that have seen their total employee numbers remain somewhat constant have done this by simply changing the makeup of their workforce and skewing it towards younger employees. With increased automation, there is the belief that junior people can do more with less, and that they can do this just as effectively as experienced professionals did previously without the technology. The only difference being that they do not now demand the higher total compensation packages that were common prior to 2008. Instead, it is now seen as a more cost-effective way to run a business to have just one seasoned professional overseeing a group of technology-savvy juniors, with these juniors replaced by graduates when they start to become too expensive for the firm's cost structure. Of course, it is often the case too that by keeping the desk continually staffed by younger people, they will also be more technology adept and able to adapt faster as markets evolve, for instance, learning and using a coding language like Python. In the current environment, though, the main driver will remain for the foreseeable future the lower costs associated by having a workforce made up of junior hires.
You can use Bloomberg to identify themes in the financial markets, like those covered in the lessons you just watched. Let's take this function, FAGO, for example. FAGO provides a wealth of financial data for companies and equity indices. Suppose you want to analyze employee data at a company. You can find this on FAGO by going to the tab labeled 7, Additional, and clicking the subtab 21, Employee Data. Take a look at the data under Product Brand Segments. In absolute terms, which segment added the most number of employees between 2016 and 2020? Click Answer to submit your response. Correct. Corporate and investment banking added almost 13,000 employees in the department, over the 2016 to 2020 period. Click Continue to move on.